Hey there, everyone. Dave Keller here with StockCharts.com, and welcome to this special edition of The Final Bar. No doubt cryptocurrencies have been a key part of the story for the markets in 2023. We've all been following the rise and fall and again rise of Bitcoin and other cryptocurrencies really coming into their own as we enter into the fourth quarter. It turns out there are actually some seasonal tendencies worth paying attention to, and I was super excited when Adrien Zduńczyk, one of our frequent guests here on The Final Bar, and also a friend of StockCharts TV, Jeff Hirsch, editor of the Stock Traders Almanac, shared some of the research they had done, some early returns on seasonality in cryptocurrencies. We thought it'd be really fun to invite Adrian here to share some of the work that had been done, sort of set the stage by looking at the market environment and then thinking about what this might mean for cryptocurrencies going forward. Adrian, so good to see you again. How are you?
It's such an excellent, feeling and energy to be back on the show, Dave. And thanks so much. I'm really doing much better right now that I get the chance to talk to you.
No, it's a pleasure. And it's been so much fun to get some of your perspective in as we've sort of tracked cryptocurrencies through periods of volatility, through sideways periods, and now really the uptrend resuming. I think we're all interested to see where you see things headed from here. But set the stage for us. When you look at the markets here in November of 2023, what are you seeing?
Yeah, that makes a lot of sense, right? So I've got a couple of charts down the sleeve, so hopefully I'm gonna be able to tell you a little bit and not bore you all to death with all the information, with all this stuff. So myself as a charter market technician, as a fresh year charter market technician, if you will, um, there is a dream that I have. There's this vision where everybody who uses technical analysis, that they use it for facts reason, for searching, finding the facts, finding the numbers, things that don't lie, instead of trying to picture their own emotions, hopes, and desires into the screen, right? So when I look in November 2023 at the charts, be it the stock market charts, be it the Bitcoin, crypto, all the crypto charts, they're telling me one thing. They're telling me this is a rising trend. This is a rising dominant tendency and trajectory of the market that continues to go and roll higher and higher and higher again and again and again, even despite some local turbulence. So this is what a bull market look like, basically.
When you think about the S&P 500, we've talked about the S&P, the NASDAQ here in November, really starting to break out. There's this big question mark in August, September, October. Now a lot of things that have been lagging now starting to work, and the major indexes moving forward. Is this an encouraging sign, and what do you see kind of going forward here?
Yeah, that makes a lot of sense, right? So uh, long story short, we definitely hit the base up there with 2022 midterm bear market, right?
Mhm.
And the first time I came across the Jeff Hirsch's seasonality studies, they were actually talking about this midterm seasonality right way ahead of the time, and it checked out pretty well. It checked out pretty well as well for the pre-election year that 2023 is on the list. And the market rotation towards to the upside is present everywhere, and where it's present everywhere, and there's this breadth effect, and there's this whole kind of like a whole army movement rather than just one lone rider. This tells me that, well, there's this awakening, that there's this rotation to the upside that is actually impacting the economy itself, right? So even though there's been still a lot of struggle on the economic side, right, the macro finance is still tight on the money. The interest rates are still, kept high, maintained on a high levels, unseen since such a long time, especially for the pace of rising the interest rates, which killed a lot of banks. The banking sector has suffered a lot. The businesses have suffered a lot. People, started basically getting less and less money, right, which was a lagging effect of the bear market. So the fact that we improve so much on the markets has a substantial effect on the economic side as well, because the more money actually people make as traders, in the markets, the more money they can spend on goods, the more money they can put on the
Mm.
services, the more money they have in the savings, the happier they feel, right? There's this overall sentiment improvement that empowers the economy. When people feel like, committing to the and contributing to the economy, it makes the whole world better. Everybody's happier, isn't it true?
I hope so, right? You'd hope that's the case. So it's interesting as you're looking at the S&P. I know one of the other ratios that you've referred to before when you've come on our show has been what we call offense versus defense, right? Consumer discretionary versus consumer staples. What is that telling you about the conditions now in terms of risk appetite? People taking risk or avoiding risk at this point?
Right on. So real quick, right, in order to get to the XLY and XLP,
Yeah.
again, the most important point about the S&P and the whole, which is a pretty fair average of what's happening in the stock market, for the large caps, is this evident rise in trends, right? And by
Mm.
tracking even, not so much of those local turbulence, those local fluctuations that we see in the chart, but overall focusing instead on the direction and the angle and the slope of the 200-day moving average representing the bull market or a bear market. This is the way how we define basically the bulls and bears, right? For the big bears and the big bulls, and that's exactly the term that you're also going to see in the next chart, right? So let me just ping in real quick the XLY and XLP, right? And there's this evident market rotation not only on the bar action up there in the chart, representing the relative strength between the consumer discretionary and the consumer staples that I learned so much about from you, Dave. Right, you were my inspiration for getting deeper and getting my hands on this relative strength ratio, along with the works of Julius de Campanaro, and the RRG, the relative rotation graphs, such an excellent tool. So by tracking the trends, right, we are tracking the actual nature and the direction, and we know that those trends are like big speeding trucks. Once they start accelerating, it's going to be super hard and super difficult for them to stop at one point, right? So when I get all those keynotes and speak in front of people about technical analysis, which is so hard to understand at times, so when I try to put it in layman terms, I compare it to like a speeding truck, and there's the second law of Newtonian dynamics, if you will, right? So if you accelerate the stuff, if you add the force to an object and it starts moving and it starts accelerating, it's like you drive a truck. Then the heavier the truck is, the faster it goes, the bigger of the moment, the greater the momentum is, the greater the impact, the greater the impetus, right? So the greater the impetus as well, that is dependent on the size of the truck. You can compare that and take it to the financial world. So the size of the truck is like the size of the market, and size of the market is a market capitalization, right? So if you take the market capitalization and pair it with the actual again velocity, if you will, how fast it changes, then it tells you about the momentum. So trying to stop big major trends, the ones represented by the 200-day moving average, just like we are looking at here, that started rotating somewhere in the Q2, Q3. For this XLY XLP ratio, this tells me that continuously and consequently, the consumer discretionary things that we want over the things that we need. Again, this is a quote from you, Dave. Is exactly what tells us that this is a direction for the bullish advantage, right? So this persistence and this continuation higher is a good thing for the bulls, and this subscribes itself very well to the overall seasonality of 2023 being the pre-election year. That quoting again or paraphrasing the excellent works by Jeff and his late father, Hirsch is going to take us to 84 years since the 1939, since the Second World War, and only one loser on the pre-election year ever since. So one loser in 84 years is a spectacular
decent record, right?
event. It is a crazy record, and it subscribes itself so well. 19 out of 20 times, the pre-election years were bullish, closed higher than they opened. So there is not a single reason to believe, at least for now, that this tendency is going to change and immediately the whole market is just collapse, right?
Yeah.
We don't know what's happening on the right-hand side of the chart. We only know what's happened for facts, and because we rely on the facts, because we choose to rely as market technicians, as charter market technicians, we choose to rely on evidence-based technical analysis, on factual information, on facts and data rather than hopes and desires. We focus on the left-hand side. And if the averages representing the bull markets or the bear markets, if they rise or fall accordingly, if they continue to move and they continue to move on the absolute price basis, on the relative strength basis, well, then this is a fact that this is a bull market and there's nothing to argue. This is a irrefutable evidence up there. And there are so many other charts, including Bitcoin, that I also have that subscribe itself to this idea.
This is great. So I'm eager. You mentioned the seasonality for stocks, and certainly in a pre-election year, we had Jeff on our show probably September of last year, and he laid out what the next 12 months would look like. And it's been pretty close to what he talked about. I mean, it's been really, really good. I'm eager to get to your discussions that you and Jeff had that culminated in this research on seasonality for Bitcoin. Take us into the crypto space, what you're seeing, and then get to the seasonality. We're very excited.
Right on. So long story short, the Bitcoin has been having a lot of course, ups and downs and a lot of volatility that it's famous for. It made a lot of people millionaires and billionaires, and it also made a lot of poverty and spread it across the people, right? It is a very almost, I would say, lethal weapon from a financial perspective, because the volatility is a two-sided sword, right? It's kind of like a double-edged sword that can make you a lot of money and can lose you a lot of money. Not everybody enjoys making 10x on a portfolio. Nobody really likes losing 10x on a portfolio, or getting 99% drawdown, which is why it's so important to manage the risk. And we can manage the risk with technical analysis, with techniques such as price action, such as volume analysis, breadth analysis, right? Momentum, volatility, and so on. And even the correlation studies that we have in the weekly chart up here, at the bottom of a chart, there's this the correlation, the 7-week correlation coefficient that I haven't tracked for S&P 500, and this relationship with Bitcoin, right? So the correlation is an actual ratio of the covariance of how Bitcoin and S&P 500 co-vary together, how they change together versus the actual product of the standard deviation of Bitcoin and standard deviation of S&P 500. What it tells me is that the ratio is right now slightly, getting more and more positive lately after fulfilling to a lot of dip, right? There was a very heavy dip. And when we go actually and check in the history, this dip was the deepest dip basically that happened since, let me just find the line. Is it going to be here? It was the deepest dip since 2019.
Yeah.
Okay, so that, again, when it happens once every 4 years, it is infrequent, and hence it is a strong signal. It has to be taken into consideration, right? So very deep relationship that is inverse. What I've noticed is that it happens typically at major and some sort of like major reversals or some major continuation signals, right? It rarely ever happens. For most of the time, Bitcoin is positively correlated to the stock market per the large cap index. Still, whenever that happens, that there is some inverse relationship that Bitcoin and S&P 500 trade differently. Most of the time, at least in 2023, that happened on the local bottoms, right?
Mm.
So whenever the correlation goes deeply negative, up there, Bitcoin actually bottomed and rallied after, which is pretty interesting on its own. So knowing overall and tracking those long-term trends, has been one of the dominant points on my agenda for the article that we released with Jeff, because Jeff and I put together the seasonality of cryptocurrencies analysis of recurring price trends in Bitcoin, and we released it on 26th of September, marking on purpose the worst day of a worst month for Bitcoin, because September is the only losing month with 6.5% negative gain throughout the year. Was checked out pretty well in line with the expectations from the seasonal patterns. So again, there is a lot of alpha, a lot of value that we actually shared up there, myself and Jeff, for free on the 26th of September. And ever since, there's been this, one-to-one, basically 100% conversion and prediction to actual reality, what happened. So we're not going to go through all of this. However, what I've noticed, while talking to a lot of banks, to a lot of institutions, to a lot of fund managers, to wealth officers for the family offices, again, there is things that seem obvious to me as a crypto native person, are not really obvious to many of the people out there. And when I speak with all those institutions, with all those bankers, with the high net worth individuals, there is this misunderstanding and misconception. There's a lot of prejudice and a lot of bias, even there when I would least expect that, right? So when I talk to the people, they, the question that I get, how is Bitcoin even valuable if it doesn't generate any cash flow? Right? Because it's centralized, because it's not centralized, that doesn't generate cash flow. It doesn't kind of like fulfill itself into the traditional stock market model. It by this understanding, in this understanding, would not even have any slightest piece of value. Well, the value here, it lays in this and stays in this utilitarian approach, right? So whenever the war sparks, there is, of course, this very sad events on the Russian-Ukraine side, as well as the Israel and Palestine, all those conflicts, they shouldn't have happened in the first place. So a lot of people suffer, and they shouldn't be suffering. That is really a bad thing. right? Well, what I've noticed Bitcoin wise is that Bitcoin serves as this utilitarian tool that transfers the wealth, right? Because if you've owned all your wealth in gold, you're not going to be able to get it out of a country in a conflict, in a military conflict, so easily. Um,
Hmm.
when compared to sending one 5-second transaction that costs you $5 for the same amount of wealth transferred in Bitcoin on the other side of the planet in no time, right? So this different type of values that Bitcoin have that are different, that Bitcoin has that are different than the traditional stock market model, make it correlate. Make it connect with a halving cycle that it is, because every 210,000 blocks um, per the Bitcoin code protocol as a cashless payment system, it halves, means that halving rewards go by half. They're reduced by half. Becomes approximately every 4 years. It approximately becomes incrementally more expensive and
Hmm.
unprofitable to mine the same amount of Bitcoins, right? So there's this digital scarcity effect. And um, the word has it that actual fourth halving is right now projected to happen in April, on 14th of April. It is a floating date still. It is April 2024. The closer we get to the date, the bigger the likelihood. However, what is important is the seasonal pattern of halving is that Bitcoin always rallied hard after the halving, fulfilling itself ready to about 90x rallies if we had in the past, to 30x rallies, to 7x rallies, from the actual halving price, all the way to the peak, right? So ever since the first halving to the peak of 12,500 in 2013, we managed to pull off like 9,000% gain. Then the next halving number two, all the way to subsequent peak in 2017 to $20,000. That was a total of 30x or 3,000%, 700% from the post-COVID halving all the way to $69,000. So we'd have this repetitive pattern of driven as well by this fundamental scarcity that pushes Bitcoin higher after the halving. So Bitcoin always brings the all-time high, always brought the all-time high, and always rallied hard after the halving, and it never came back to the same prices, which means that everybody who bought on the previous halving days, they are still in profit, and they are in deep profit, and for most of the time they were in very deep profit, right? Because of those rallies. So long story short, rejecting those types of rallies, again, 9,000%. Who wouldn't want to make 900%, 9,000%, right? So rejecting Bitcoin and its actual opportunity cost, for not taking in, because it doesn't fulfill and subscribe itself in the same way to stock market model, is a losing bet. And then we have this average monthly performance chart of Bitcoin, right? With September as the only losing month on record. And I'll just try to keep it short, right? Because October and November are the big rock stars. November is the biggest outperformer, is the biggest outlier in the whole year on the breakout, averaging approximately 43% of a return. Again, when compared to 6.5% as the only losing month, right? On the negative side, October was actually outperformed per the latest data, because October closed 27% higher than it opened, while the average monthly performance is approximately 15-20%, depending on the actual sources, right? So what it tells us is that Bitcoin somehow contributes consequently inconsistency to the September lows, and it shots itself up in the direction and in a manner very similar to Nasdaq. So Bitcoin has been trading more and more aggressively, similar to Nasdaq, and even more similar than to S&P 500. It actually trades, like I said, to Nasdaq, right? So at the top of this left-hand side chart, there is the average, there is the long-term average, the 200-week average of the 52-week correlation between Bitcoin and Nasdaq index, right? So when we take it, hold on, let me just put on the pen. The average itself ever since 2000, I think it was what's it gonna be? 2015, right? So 8 years until 2023, the correlation has grown by almost 400%. All right. So the average correlation, 200-week correlation is directional. It doesn't, it is in the uplifting, lifting trend. And this tells me that the Bitcoin becomes more and more similar to Nasdaq, and because it becomes more and more similar to stocks, to Nasdaq, it trades like a risk asset. It will also fulfill itself and rely on the seasonal patterns of what Nasdaq does. And such was one of the conclusions of the chart of the seasonal pattern that Jeff named remember to buy in September, right? He also loves to say buy in October and keep your portfolio sober. And actually both of those patterns subscribe itself, is Bitcoin really follows them because they are similar and characteristic to Nasdaq. Bitcoin actually follows similar patterns via the means of correlation. It is an attractive alternative to Nasdaq for risk-seeking traders. And just like Nasdaq has the best 8 months strategy, where you basically put in a bottom on the market, somewhere in an October, not typical October low. It is actually November, in December all the way to April to May to June to July, where you tend to see massive positive growth. And Bitcoin, again, fulfills this 4 months, the worst 4 months, from July all the way until October, and November through June, July, similarly to Nasdaq. It is actually the same seasonal pattern, right? So there's a lot of similarity in the September. Remember to buy in September checks out so well. And at the time of releasing that on September 26th, Bitcoin was about 60% year-to-date return, while right now we are floating close to 130%. Right. So ever since release of this article, that was on September 26th, again, the worst day of the worst performing month, we are actually looking at a 60-70% growth, right? Percentage point up there growth. This is pretty cool, and a lot of profit to have been made up there. So the whole trade setup again was giving us again the pattern itself about September. It was telling about the Q4 rally that is quite typical and transparent and evident over the years for Bitcoin. Again, typical September low for Bitcoin as the only losing month. Remember to buy in September, into positive October, into an even more positive November, and then Bitcoin kind of like joins on the bandwagon of the Santa Claus rally, if you will, even though it's a little bit lesser, right? So all that again just takes us into understanding that the long-term trends are upwards, right? The long-term trends are upwards, not only for stocks, they're upwards also for Bitcoin. And having seen this consecutive growth, right, just more on the technical side than the seasonal side alone, we are talking about confirmed, reliable bull market. And perhaps, I have a terrible memory, Dave, but, one time we spoke, I think the first time we spoke about Bitcoin, it was early in the year, wasn't it? Like January, February, what was it? Remember?
That sounds about right. Yeah.
Right. So that was this powerful breakout over $20,000 that we talked about, and how this breakout was actually credible. That this breakout was taking us somewhere in the places that not other breakout before took us, in the long time, right? Because the 200-day moving average representing this, represented by this black curve, stopped falling down. It started flattening into plateau and reversed, and it actually shifted the gear and start moving, the opposite direction. So this $20,000 breakout, this critical round number threshold that just lined, closely with the 200-day moving average resistance at that time, and we know that those round numbers work. There's a lot of magical thinking behind it. Those rule of thumbs, we love round numbers. They're easy to remember, right? To wrap our minds around that. So 20,000 was broken, and it was broken with very decent, again, time and volume burst and volatility burst. And the good thing is that it persisted, right? And ever since, we continue to move higher, even though there was a local choppy range, 25 all the way to almost 32,000, again, the raw numbers. We continue to move higher on a 200-day average basis. So with 200 days of data align and move higher on average, there's direction that is irrefutable. There's direction that cannot be denied because it is not due to a chance, right? If 200 days straight, Bitcoin moves in one direction and it continues to do so for 10 months straight or so, it is not due to a chance, because what are the chances? What are the odds that a $700 billion asset, is that someone is just going to chip in with 200 billion and just not do anything about it without even noticing? Right? It's impossible for somebody to pump in 200 billion into the market without noticing and realizing it happened, right? So there has to be some actual reason, and the reason is demand. The anticipation towards the ever bullish halving that decreases the mining rewards and increases the digital scarcity. When there's less of it, we wanted more. And there's the whole technical thing and the whole technical beauty using the charts and the price charts is that it informs us about those events before. We got the early warnings at $20,000. There were some notes about the pullback. I actually was lucky to add and chip into my long-term portfolio at 20,000 back again at the drop up here. So there was some luck. The dominant trend is rising. The breakout again is valid. It happened. It happened on the volume spike. It happened on the volatility spike. We've been almost 3 weeks above this threshold of the previous resistance, and we are kind of like making ourselves comfortable even there. We almost had an attempt of a $38,000 breakout. And there's a lot of seasonal, again, pattern, just presence that reinforces the bullish price action, right? So by tracking those technical, by tracking those techniques, the price action, just making a simple higher highs and higher lows, observing the moving average, the moving average movements, the slope and the direction that is persistent, that is apparent. What's happened on the left-hand side that cannot be ignored because it happened. What happened is 100% likelihood event. Right? It doesn't belong under any question. It cannot be questioned. What can be questioned is on the right-hand side of the chart. And that is probably a source, again, to a lot of anticipation, to a lot of FOMO, a lot of fear of missing out. When we have BlackRock CEO Larry Fink talking about Bitcoin as a flight to quality, then there is a lot of role model responsibility that I think many other funds are going to file in. And BlackRock has just listed Ethereum spot ETF application yesterday or today, if I'm not mistaken. So there is a lot of buzz into crypto from 2023, and we are heading into election years, which are typically an extension to the pre-election years, which are the most bullish years on records, right? So I think, again, might be wrong. We can never know for sure what's going to happen, and take it with a grain of salt because I can only comment with guaranteed certainty what's happened.
Yeah.
I'd say if we are to make any predictions, then I'd say we are up for 1-2 years of very good rallies, and let the golden cross, of the latest 200-day and 50-day moving average crossover just give you a little bit conviction that it actually happened, and that is about it.
Adrian, that was awesome. That was like a little 20-minute masterclass on how to apply technical analysis for analyzing risk, but then really particularly with Bitcoin. That was the most comprehensive sort of breakdown of Bitcoin that I've seen from a technical perspective. There, a couple thoughts real quick. I mean, there's no denying that breakout from that 25,000 to 31,000 range. That was a big one, right? And it felt like for a while, Bitcoin was sort of languishing as stocks were coming down. Things have changed quite a bit. There's been a lot of discussion, ETF filings, expectation that ETFs are improved or approved by the government. How much do you think that upside that you see in Bitcoin would be fueled by spot ETFs actually being readily available in the US and elsewhere?
That's a perfect question, Dave. Thank you for that. So, funnily enough, I just had a discussion with my good friend Doug Bonpart as well, who's an excellent wealth manager, about the Bitcoin for millennials, right? And how the ETF for the BlackRock, and just sitting and paving the way for so many other ETFs as well as the main key player as the biggest fund, how it can boost the adoption, right? How it can actually make again, just all the naysayers, all the doomsayers, just prove them wrong in one thing, right? Because the main argument, the main reason, then all the naysayers and the doomsayers trying to say, oh yeah, listen, it's gonna fail like the other rallies. This is not an asset. It has no value. It doesn't generate cash flow, right? So there is a lot of prejudice, of course, and the problem with prejudice against Bitcoin is that it's asymmetric. It is exponentially asymmetric, right? Because the opportunity costs are basically measured in thousands of %, right? This is probably like no other asset at this caliber, at this quality, reaffirmed and confirmed as from the social proof perspective. Again, when we have people like Larry Fink talking about that as a flight to quality, when we have all the utility in the world, and Bitcoin checks out again as a means of transferring the wealth, the means of exchange. during the geopolitical war times, this really adds a little bit credibility to it, and the credibility is necessary because the main argument of all the naysayers was that it was not credible, right?
Yeah.
That was unreliable, that it has to be some scam, and it has to be some fugazi. So by getting access to ETFs, we get an access as a means as well for a lot of adoption points.
Yeah.
And the good thing is that the bull market again just seeds a lot of new investors, and it does seed a lot of new projects. And there is this good acceleration on the technological side combined with the AI, artificial intelligence, ChatGPT, Midjourney, all the stuff that are coming up on the AI side scene. This all can work in conjuncture, right? So we've got crypto, we've got gaming, we've got the AI, which are separately in its own gigantic markets, and they are all checking out together in crypto right now. Right, so there's combination of the synergy, this network effect that can even additionally empower cryptocurrency as a whole. So again, I don't have any targets as a trend follower, right? Because I follow the trends, I try my stops higher based on adaptive ATR, and I'm just good. I lose 70% of the time. So when people ask me, what I travel a lot, when I get a question, what I do for a living, I say I lose money for a living because I lose 70% of the time. Right, I'm wrong 70% of the time. So I stopped trying to predict the markets. I just do what the profitable trading system tells me to do mechanically, as much mechanically as possible. So I go wherever the trend takes me. However, if I were to place any bets, my bet is that we are starting just the third wave, and the third Elliott wave is typically the biggest one.
Sure.
Technically, mania wise, the mania phase, this irrational exuberance wise, for the next 1-2 year rallies. And who knows, maybe midterm elections of 2026 are going to check out as well as they did for 2022.
Adrian, this was fantastic. You mentioned you lose money for a living. I would argue if you are losing money, which I think is part of the game, you're learning doing it. And that's what I love about what I've learned from you is just an eager technical analyst applying the toolkit to a new market and a growing market, but doing it the right way. And I hope others sort of learn from some of your mistakes and learn from some of your wins as well, which I think are pretty meaningful. Thanks for talking us through this upside potential for Bitcoin. I really appreciate you sharing the seasonal work that you and Jeff Hirsch did. Again, congratulations. That's the first I've seen of that sort of lens applied to Bitcoin. I think it's well done, and I appreciate you sharing it with our audience here. Be well and stay safe. Travel safely back home, and we'll talk to you again soon, all right?
Thank you so much for having me, Dave. This is always an excellent honor to see you and to talk to you, my friend.
That's Adrien Zduńczyk. Adrian's the founder of the Birb Nest, a cryptocurrency expert and a capable technical analyst, as I think you could easily tell from how he was talking through the charts. And again, some of that work about the correlation of Bitcoin with the S&P, with the NASDAQ, the seasonal tendencies, what tends to happen in the fourth quarter, and thinking forward to the Bitcoin halving potentially coming in the April timeframe of 2024. Really helpful to think about all the short-term movements we've seen, how it fits into some of the bigger picture movements. A great and big thank you to Adrien Zduńczyk of the Birb Nest joining us from Dubai and sharing some expertise with us. Also to Jeff Hirsch of the Stock Traders Almanac, who couldn't be with us, but did some fantastic work along with Adrian to produce that research that he shared with you. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great one.